Hi everyone. Okay, let's continue on with Eastman Technology. So again, we're looking at the trial balance, and we have already created the classified multi-step income statement or statement of income. So now we need to look at all of the other areas that we still need to create. And the two statements that we need to create are the statement of changes in equity, and we need to create the statement of financial position, also known as the balance sheet. Okay, so if you remember back to Financial Accounting 1, once you create the income statement, we have the net income or the profit for the year, and then that number goes into our statement of equity. So therefore, the next statement that we have to create is the statement of equity. All right, so let's scroll down and let's have a look at our statement of equity. Okay, so just like, well, actually, no, they're only giving us 1 year of statement of income, but they are giving us 2 years for the statement of changes in equity. And usually an organization actually provides 2 years worth of information, but this actually gives us an opportunity to have a look at the changes. Okay. So as I mentioned before, the two areas we're going to be focusing on, and as you can see, those other two areas that we're not going to be focusing on don't have any information in them. So we're looking at share capital and we're looking at retained earnings. And we need to look at the opening balance and then anything that happened during that year and then come up with the ending balance. So for example, for 2013, the share capital had a beginning balance for the year of $285,000, which, if you remember, comes from the closing balance of the year before. And then common shares issued 15,000. So obviously during the year 2013, they sold $15,000 worth of common shares. So therefore, for the end of that year, our share capital, the ending balance, is $300,000. Okay, so let's have a look at retained earnings. So retained earnings balance at the beginning of the year, again, comes from the ending balance of last year, which is the $205,000. Profit applicable or available to common shareholders. Now, if we go back up and look at our income, profit for the year, $97,500, scroll down. Profit applicable or available to the common shareholders, $97,500. So that's added in to become part of our retained earnings. And then we need to look and think, okay, are we paying our shareholders dividends this year? And in this case, yes, we are going to pay out dividends of $47,500. So we're going to keep or retain $50,000 worth of retained earnings from this year. So therefore, we've got an ending balance in retained earnings. We take our opening of 205, we add in the profit, 97,500, subtract off our dividends of 47,500 to come up with an ending balance for the year of 255,000 in retained earnings. So we know what our share capital at the end of the year is, and we know what our retained earnings are at the end of the year. Let's go look at the equity section of our statement of financial position. Whoops, I think I went quite fast through that. Okay, here it is. So look, equity section, right? Equity, share capital, 300,000, retained earnings, the 255, giving total equity of 555,000. Okay, you don't have to include the line contributed surplus, and you don't have to include the line total other comprehensive income or loss. Okay, we'll just focus on the share capital and the retained earnings. Okay, so now we're looking to create our statement of financial position. So we'd go back to the trial balance that we have and pull out all of our assets. And in this case, again, we're categorizing or classifying the different categories. Okay, so our assets, we're putting non-current assets or long-term assets, and we're putting our current assets. So for our non-current assets, we have grouped together one account name called property, plant, and equipment. And then we subtract off our accumulated depreciation. If you remember, accumulated depreciation is the accumulation of all of the depreciation expense that we've put through since our company started. So we have an accumulated depreciation of $140,000. And if you look at last year, the accumulated depreciation was $100,000. This year, the accumulated depreciation is $140,000. So this year's depreciation expense must have been $40,000. Let's go have a look. Here's our income statement, and we've got depreciation. Let's see, $40,000. So again, that's accumulated. Okay, so therefore the total of our non-current or long-term assets is $1.2 million. Then we look at our current assets. Again, assets that are constantly changing, such as our inventory. Again, they're using a new terminology here. Instead of listing it as accounts receivable, they're calling it trade receivables. Again, different organizations call an account something a little bit different. So in this case, instead of accounts receivable, they call it trade receivables. So we've got a balance in trade receivables of $300,000. We have prepaid expenses of $60,000. Again, if there's any of these terms that you don't quite remember what they mean, there's some great information and descriptions in this chapter in the textbook. So please feel free to go back and have a look through to refresh your mind as to what a prepaid expense is. Then we have cash and cash equivalents for total assets of $600,000. Total current assets of $600,000. Our total assets need to add the current and the non-current to give $1.8 million. Then as you can see, we've got our equity and liability section. Oops, flip through too quickly. So we've got our equity there. Let's look at the liabilities. So again, we have non-current liabilities or long-term liabilities, so a long-term borrowing. And then we have current liabilities. They've called it, again, our payables. Instead of calling it accounts payable, they've called it trade payables. We have a short-term borrowing, and what that means is where it's under the current liability section, that short-term borrowing must be going to be paid off within 12 months. Okay, we have accrued expenses, so expenses that we know have happened that we haven't received a bill for yet. And then we have taxes payable. And obviously where that taxes payable is listed under current liabilities, it's a tax that has to be paid within the next year. So then we've got our total current liabilities, and then add that with our total non-current, our total non-current liabilities to give us our total liabilities. And then we add our total liabilities with our equity from the previous page of 555. And then that gives us our total equity and liabilities of 1.8 million. Balance sheet has to balance. Come up here and we have total assets of 1.8 million. So we balance. Okay, so that's an overview of equity and statement of financial position, or the balance sheet, and the extra terminology that's involved because it's a corporation, and also where we're doing a lot more classifying so that the information is easier to read for our users and more relevant. Okay, so at this point, move on to your next step. So in these next 2 weeks, we're going to be looking mostly at statement of income. And then in week 4 and week 5, we'll be looking more at statement of equity and statement of financial position. Thanks, everyone.